most important accuracy checks in bookkeeping: bank reconciliation. Bank reconciliation is simply the process of comparing the business's cash book, our internal record of bank transactions, with the bank statement provided by the bank. We do this to make sure both records show the same balance. Why is this necessary? Because timing differences and errors can easily occur. The bank may record something before or after we do, or we might have missed a transaction altogether. The main purposes are to spot timing differences or errors, to confirm the real balance available in the bank, and to detect fraud or missed entries before they become bigger issues. It's completely normal for the cash book and bank statement not to match exactly at first. There are many legitimate reasons for this, and understanding them helps you reconcile accurately. Common reasons include: first, outstanding checks. These are checks we've written and recorded, but the bank hasn't cleared them yet. Until the supplier cashes them, they don't appear on the bank statement. Second, deposits in transit. That's money we've received and recorded, but the bank hasn't processed it yet. Third, bank charges. The bank may deduct service fees automatically, and we only find out when the statement arrives. Fourth, standing orders or direct debits. They are automatic payments that the bank processes but haven't yet been entered in our cash book. Now that we understand the basic idea of bank reconciliation, let's look at how this works in real life, using an actual bank statement and our own accounting records. We're going to look at the transactions from two different viewpoints, the bank's and ours. On the left-hand side, we have the bank statement. This is the record prepared by the bank, not by the business. The bank statement shows an opening balance, a list of transactions, and a closing balance at the end of the period. The paid-in column shows money coming into the bank account. This could be customer payments received, cash deposits, or transfers received. When money is paid in, the bank balance increases. The withdrawn column shows money leaving the bank account. These are payments the bank has made on behalf of the business. When money is withdrawn, the bank balance decreases. Not all banks present statements in the same way. Some banks use paid in and withdrawn, some use debit and credit, some use plus and minus signs. Regardless of the layout, the meaning is always the same. Money in increases the balance, money out reduces the balance. If a bank uses debit and credit labels, remember, credit means money into our account, debit means money out of our account. That's because the statement is written from the bank's perspective, not ours. Now let's look at the right-hand side, which shows our general ledger, cash at bank. Cash at bank is an asset. Assets increase on the debit side and decrease on the credit side. When we receive money, such as the £1,000 from our customer West Limited, our bank balance increases. Because our asset increases, we record this on the debit side of the cash at bank account. When we make payments such as rent, utilities, or card payments, cash leaves the business. We record these on the credit side. At the end of the period, the bank statement shows a closing balance of £1,400. Our cash at bank account also shows a closing balance of £1,400. Our cash at bank balance reconciles to the bank statement balance. Let's now look at a different situation. We have received the bank statement for the period, and when we compare it to our cash at bank account in the general ledger, we can see that the two balances do not agree. We must update the cash at bank account for items that appear on the bank statement but are missing from our records. Looking at the bank statement, we can see several transactions that have not yet recorded. The cash at bank ledger must be adjusted for all bank statement items not yet recorded in order for the balances to reconcile. Once these entries have been posted, the cash at bank account is fully updated and reflects the true cash position. The balancing figure, balance carried down, is written on the credit side to make the totals match. Now let's look at the opposite situation, where transactions appear in our cash at bank account but do not yet appear on the bank statement. This usually happens because of timing differences. We record a transaction as soon as we issue a check to supplier or receive cash or check from customer, but the bank will only record it once it is processed. So our books can sometimes be ahead of the bank. In our case, we issued a check to supplier which hasn't been processed by the bank yet, and we recorded a check which we received from our customer but hasn't been processed by the bank yet. These items do not appear on the bank statement yet. Transactions recorded in the cash at bank account but not yet shown on the bank statement are not adjusted in the ledger. We do not change the cash book for timing differences. This rule is critical. Instead of posting journals, we include these items in the bank reconciliation statement. Unpresented checks are added back in the bank reconciliation statement, and deposits in transit are deducted. After these adjustments, the balance should agree to the bank statement closing balance. Once the bank processes these items, they will automatically appear on the next bank statement and the difference will disappear. Now let's look at a dishonored check, which is treated differently from timing differences. A dishonored check occurs when a customer pays us by check. We record it as received, but the bank later rejects the check. This can happen due to insufficient funds, a cancelled check, or an error on the check. When the check is dishonored, it means the cash was never actually received, so the original entry we made in the cash at bank account is incorrect. Initially, when we received the check, we debited the cash at bank account and credited the trade receivables. When the check is dishonored, the bank removes the money from the account and we must reverse the original receipt. To correct this, we credit the cash at bank account and debit trade receivables. Let's summarize. When we compare the bank statement to our cash at bank account, every difference we find will fall into one of three categories. If a transaction appears on the bank statement but does not appear in our cash at bank account, this means the bank knows about the transaction, but we do not. Because this represents a real movement of cash, we must record it in our books. We post these items to the cash at bank account. Examples are bank charges, direct debits, standing orders, and interest received. If a transaction appears in our cash at bank account but does not yet appear on the bank statement, this is usually a timing difference. We have already recorded the transaction correctly, but the bank has not processed it yet. In this case, we do not post anything further to the cash book. Instead, we explain the difference in the bank reconciliation statement. Examples are outstanding checks and deposits in transit. Dishonored checks are different from a timing difference. We originally believed check had been received and recorded it in our books, but the bank has rejected the check. This means the cash from our customer was never actually received. As a result, our original entry must be reversed. We reverse the original receipt by crediting the cash at bank account and debiting trade receivables. Dishonored checks are not timing differences. Here's the step-by-step method you'll use when preparing a bank reconciliation. Step 1. Compare the entries in the cash book and the bank statement line by line. Step 2. Tick off all the matching transactions. Step 3. Highlight anything that doesn't match or is missing. Step 4. Make adjustments in the cash book for any items not yet recorded, such as bank charges or direct debits. Step 5. Prepare the reconciliation statement showing how the cash book balance and the bank statement balance line up. And finally, Step 6. Make sure that after all adjustments, both balances agree. It's a very logical process. Once you practice a few times, you'll find it becomes second nature. Now, even though the process is straightforward, there are some common mistakes that can cause major confusion. For example, double entry mistakes, where a transaction is entered twice, or reversal errors, where debits and credits are swapped. Sometimes people record payments or receipts on the wrong date, which makes matching difficult. Other common issues include missing standing orders or using the wrong bank statement for the period you're reconciling. To avoid these, always cross-check your figures against the source documents, invoices, receipts, and statements. In reconciliation, accuracy matters. Small errors can ripple through the entire bookkeeping process. Finally, let's talk about why reconciliation is so valuable to a business. First, it helps detect fraud or unauthorized payments. You'll notice immediately if money has left the account unexpectedly. Second, it confirms the accuracy of your cashbook. Third, it ensures the business always knows its true bank position, not just what's on paper. And finally, it builds confidence in your financial reporting. So, to summarize, bank reconciliation is not just an administrative task. It's a vital control that ensures trust, transparency, and accuracy in the accounting process. Let's move on to one of the most important accuracy checks in bookkeeping: bank reconciliation. Bank reconciliation is simply the process